day. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Tuesday, the 12th of November, 2019, and we are freezing in Chicago. I don't know if we got up to 19 degrees without a wind chill. 19 degrees. We set new record lows and probably new record low highs for this day. And then we've got snow coming in tomorrow. So if you tell me it's November 12th and we're still in fall and it's like a bad day in February, wow. The stock market finished up, but at the end of the day, it was a little lower than this, and it makes sense. Just think about it. Tomorrow we've got the beginning of the impeachment inquiry. Then you're going to have Fed Chair Powell speaking before the Economic Joint Committee, and then he moves on the next day to the House Budget Committee. So we're going to get his idea of what's going on. Certainly, if I were in the press, I'd ask him what goes on, not what he thinks is the president guilty or not, but what if something happens with the impeachment? How does he expect that to impact markets and so on as it probably moves to the Senate? I'm giving a guess because the Democrats have been working on this for 3 years, so I don't think they're going to fail in the House to move it on. Whether it goes anywhere in the Senate, that will be the big question. Dollar index a little bit up. Mixed day in the currency markets because I think people are waiting on what we're seeing. The settlement prices in the metals were at 1230, as you know. I think the metal markets were up a bit from here at the very end of the day, as I show in my metal report. Energy markets still under pressure, and what we probably are moving to now is more of a supply coming in the line with current demand and future demand. And what I mean by that is we're starting to see American supply starting to dwindle off, and certainly next year, if the shale producers do as they're forecasting they will, and they're cutting back exploration and not drilling as much, or doing what I would call the smart move. You take over some of the shale drillers that are in trouble and you take their wells that are already drilled, a lot less money that you can put forward to keep yourself going with the production you need. As we look at the S&P, a new record high close in the future. So we're up for the week, 1.4 points, but that is a new record high close. When we take a look at the chart, you can see how the market's been coming up, and you can see, and I've pointed out over and over, an inverted head, then we'll call this a shoulder, another shoulder, and the count, as it turns out, on that doesn't have to get to it in one swoop, is around 3160 if it meets what I call the head and shoulder count. In terms of the swing lines, well, very frankly, they have been making consistently higher lows and higher highs. And that is the hardest thing for traders to trade. You know, when you get a market that was 2860 roughly, and now you're looking at 3100, and traders are caught waiting for the pullback, and their adjusted capital may not be what they want it to be. I'm also wondering if we're not getting at the point where interest rates have gotten a bit too far to the upside. In other words, yields a little bit too high. When I look at the S&P in relation to the 18-day average of closes, it's well over it. Now, to get back to it, if the market were to get back to that line in the sand, you'd have to take out the last break low, and that could cause a break there. Again, one of the things I'm still counting on this year, doesn't mean I'll be right on it, is what I term that Santa Claus rally. I've pointed out what FactSet put out. I put out what the Trader's Almanac has put out, Stock Trader's Almanac, and you get these different probabilities. Past history is just a guide. It's not a guarantee that it'll happen. But we certainly feel different at the beginning of November, or really I should say midway through, than we did a year ago at this time. You know the dime can drop at any point, and we could be in trouble if these impeachment inquiries take on the wrong tone. I don't know what the word wrong means, but if it certainly sounded as though there's a bomb that's going off here, well, I don't know how the markets would take that. If, on the other hand, we've heard that it's going to happen, we've read the testimony, it comes in as said, does that mean the bomb goes off? You're going to have to decide that, and you being the public at large. If the market continues up, 3115 is the resistance as seen by the upper Bollinger Band. In these slow stochastics, they are what? They are still embedded. So until they lose that, they're not saying, if you believe that momentum leads price, they're not saying a correction is at hand just yet. In the NASDAQ, you got the embedded reading. You have the pattern of higher lows, higher highs. Like the S&P, as you've hit the upper Bollinger Band and you come back here, you could see it. You've backed off to the right-hand side. Doesn't mean price backs off. It's what momentum in price does. And if the market wants to lurch forward, 8370 area is the resistance. In the Dow, the market has still got the pattern of higher lows, higher highs, the embedded reading. Until you do something to lose that embedded reading, pullbacks are just that. And in the Russell, you still have the loss of the embedded reading. It's the one of the indices that's down. What I don't like is, as bearish as I normally am when this happens, every day that goes by, you're getting a jump in that 18-day average of closes, taking away 3 to 5 points of the possibility that if it were to go down to that number, profit loss. So now, instead of it being when it first lost it back here to down here, you've probably climbed 10, 15 points in that market. In the VIX, you lost the embedded reading on the downside. So unless it gets it back tomorrow, if this is going higher, it's often a sign of what? The futures on the stock indices want to work a little bit lower. So you've got some divergence going on here. Here's what I was saying about looking at the T-bonds. They have made their stand against the lower Bollinger Band. The market's had an outside day up and it's oversold. If you take out today's low, yeah, then I would have to say, whoa, I don't know where we're going on the downside. But until that occurs, I'm wondering if I can't now say higher lows, higher highs. I'm looking at that hard. In the 10-year notes, we still have the market lower highs, lower lows, running the lower Bollinger Band. And like I just said, I'm going to be looking tonight and I want to see what this low is. I think that those arrows can now go up. The low here was 127.31 and a half, and today's low is 128.04 and a half with an outside day up. I therefore know that I'm going to be reversing these arrows, having them point higher. That means that the swing line's no longer pointing down, but I really need to get over these past rally highs. I understand what my work's going to say. The more I'm looking at it, you got to take out 128.22 on this chart to negate the downtrend, 157.7 in the T-bond to do it. I teach the swing line. I should know them. When I look at TLT, and I created them, you've got the pattern here, just like in the other. You're trying to make the higher lows, lower highs. You need to get over 135.95. You didn't do it. You got to 94 here. You had to take out 128.22. You hit only 128.04, but you missed in the bonds by hitting one tick through the highs there. So we're at a zone that if you get much higher, you probably negate this leg of the downside, which means rates fall a little bit. In the dollar index, I'll be looking to see if the market gets back under 97.97. That'd be a warning sign, I think, that this up leg has run its course. Does it have to? No. You've got the higher lows, higher highs. You can run the upper Bollinger Band, but you better embed. And right now, it's the first day today that both numbers got over 80 on the slow stochastic. They weren't there yesterday or the other days. So you can see how that's working. And as you come to the eurocurrency, it is riding the lower Bollinger Band, and it's doing the opposite of the dollar. You've got both numbers under 20 today. You didn't have them yesterday. So you're just in an oversold condition here and overbought in the dollar and stretched out in both. Stretched out doesn't mean you can't keep stretching. There's no reason to be a bottom picker here or a top picker on the other. Let the market tell you what to do. In the British pound, if you were to get over 129.12, you could set up a pattern of higher lows, higher highs over the 18-day average, looking for the potential of the upper Bollinger Band. The bigger issue is you've gone sideways in the market. So the market hasn't had much of a trend. On the close today, it did set up a downtrend with divergence. You've got momentum trying to point higher. You've got price staying under the 18-day average, so the bias is down. But I can see that if you took out 129.12, so you hit 129.13, you would have the swing line up, the bias is already up, and you'd probably kick the momentum with it. Could put in play that upper number. You could also just stall at that 18-day average if you do that. In the Japanese yen, you're still very much in a downtrend that refuses to embed. Danger, that's what I'd call it. Again, you've got a market that has hit the lower Bollinger Band right here. You haven't really done much since that occurred. I think you see that. So the first challenge of that band has pretty well stopped the decline. That doesn't mean the trend is up. It's not. It's still down, but it's in an oversold condition. In Bitcoin, if you don't see the battleground, I don't know what to teach you, because you're stuck at this 18-day average of closes. Yes, you're in a downtrend, but yes, you're stuck here. The market closed today over 88.24, the 18-day average, when it settled at 88.35. It gives the bias up, the swing line down, and momentum has worked out of an oversold condition to go flat right now. In the Brent versus WTI crude, we had gotten up near 560 difference, came back down, and now the market's having trouble at that 18-day average of closes. And when you look at the different energies, you see your momentum's trying to turn down. You've got the swing line up, both ends of it. In other words, you got higher highs, higher lows. The support in the market's back at 61.12 to 60.59. What I don't know is at those numbers, given the overbought condition, how aggressive would the buyers be? Plus, if you got down there, you might say you got lower highs, higher lows. In other words, I don't think it's the prettiest looking of the charts. When you come to WTI crude, you've got the same thing. You've got your momentum turning down on you. You've got the trend up, support between the 18 and the 100-day average. But if you got down there, I don't know that the chart would look good at that point. In gasoline, I can argue lower highs, higher lows, 3 days in a row at the 18-day average of closes with momentum down. Again, a chart that's not throwing out signals as I see it. And I think the stand in natural gas is trying to be made against that 18-day average that you hit yesterday, and you're still stalled at it today, even with these record lows. And you're going to see the news tonight. When you turn on your local news in the U.S., you're going to see record lows and what's going on. It's nasty. I don't look forward to going home on the outside temperatures as they are in Chicago right now. Now, as I just mentioned to you, it's going to be wild over the next day, for sure. We get the House of Representatives drilling, if you will, or grilling might be the best word. They'll be drilling to get information on the president to get their impeachment vote set and move it to the Senate. And grilling is going to come from both the favorables that are on the Democratic side of their people they're bringing up to testify, and the Republicans going after them. One of the ways that a lot of traders use in markets like this is a tool they didn't have before. And these are these 1/10 the size of the regular stock index contracts. And you might say, nah, that's not for me. I want to take the regular gamble. Terrific. I'm not saying don't. What I am saying is this is a tool available, and we're not talking a few contracts trade of these. About 15 to 20% of the daily volume of whatever the regular size contract is done here. Then you might say, well, what is that? What if I tell you 100,000 contracts like in the S&P? We're talking 100,000. Understand that the daily volume in a Bitcoin is maybe a couple of thousand contracts. This is way more advanced, and this is brand new. So if you're interested in finding a way to trade, or you think you can do stock index trading, but you don't like all the risk that they have, if 1/10 fits in to what you want to do with the margins, the maintenance, well, we've given you a commission rate that we think makes it very affordable for you. $1 aside plus the exchange and NFA fees, I don't think it's too bad. So if that interests you, here's a way to go about it. And it shows you what the differences are. Instead of $50 a point, you move 20 points, $1,000. You've got a big difference here. It's 1/10, so it's $100, and it gives you a little room to build contracts, and they're fungible. You can use these against the full size. How do you find out about it? Go to our website, www.iraepstein.com, but add /microword. It's going to look just like this. Here it comes. When you get there, that's all you've got to do. To make life even easier, if you want to read about this, just simply click on the icon you see here. It'll take you right there. It's going to be an active day tomorrow. I'll probably be on TV somewhere around one of the stations because there's going to be so much to talk about. If they contact me in time, I'll let you know what time I appear on them. You have a good day. I'm Ira Epstein.